Hello, welcome to Fintech Impact. I'm your host, Jason Pereira. Today's show, I have Dr. Stephen Taylor of the New Jersey Institute of Technology. And I brought him on the show today specifically to talk about a couple of emerging trends, specifically in fintech and in fintech education, given that he teaches. And with that, here's my interview with Dr. Stephen Taylor. Stephen, thanks for taking the time today.
No problem, Jason. Thanks for having me. I'm happy to talk about one of my passions here.
Excellent. So, Dr. Stephen Taylor of the New Jersey Institute of Technology, tell us a little bit about what it is you do.
Yes, I'm a professor about 4 years now, and I have a bit of an orthodox academic background where I worked in the finance industry for 7-8 years. I started at Bloomberg, Morgan Stanley on a bond desk, a couple hedge funds. And as part of that, I gained a lot of practical programming experience, but also mixed with a lot of my technical training in math stats from school. And my main aim as a professor is just trying to bring this into the classroom and trying to get students oriented towards like what skills are in demand in the finance and fintech areas nowadays, and making sure they're able to both acquire those skills and then get their first job.
Excellent. Yes. So ever emerging industries. So I have to imagine that, especially given that we're talking about kind of an overlapping field of technology and finance and human behavior, there's a lot of things that fintech really do touch upon. So I'm glad we're having this conversation. So tell me about so you talked a little about your history. What led you to teaching in the first place?
I'd always liked teaching. My plan in grad school was to become a professor always. I somehow wound up in the industry, but I stayed like within academia a bit. Like I taught an industry practicum class at University of Chicago in 2013, one at NYU at 2016. And I thought, I really enjoyed that a lot more than my day-to-day job in the industry, and decided let's make a jump out of finance industry into academia.
So specifically today, we're talking about emerging fintech trends you're seeing, and you get involved in industry quite a lot. So if you were to sum up kind of the biggest, let's start with the biggest three altogether. What are the big three that you're kind of seeing happening around you at this point?
Really watching insurance and actually writing a bit about peer-to-peer insurance recently. I think it's an area that's just starting. We're just at the cusp of a lot of innovation is going to happen in the next 3 to 5 years. Asset management's a good number two. This the sort of progression from the first robo-advisors to more customizable asset management arms. And I guess on the third side, it's number three is probably just the general sharing of trading strategies through platforms like knack, for example, where anybody can write a trading strategy and you can now market it yourself.
Fair enough. Okay, so let's go back and unpack all three of those. So the first one is peer-to-peer insurance. So this is an interesting one because I got to think, geez, this has got to bump up against all kinds of regulation. Two people agreeing to indemnify each other, or a group of people agreeing to indemnify an individual. Talk to me about the practical applications of how you've seen that done thus far. And if you can address the regulatory challenges, that would be great.
But precisely, I think this is the key issue from a practical point of view. Most of my work on it's more of from a theoretical design aspect. So I don't know quite as much on the regulation side. You can think of the different styles of insurance sometimes we have within families and friends, for example. Like sometimes like within your immediate family, you implicitly insure yourself. You have an accident, your father might help you out with a few $100s, and it's a lot more cost effective to do that rather than have to go through a claims process where there's half a dozen people involved and a lot of overhead associated with it. And I think peer-to-peer insurance is like, how do you make a middle ground between those two? How do you sort of formalize the insurance in a way that it's more than just family and friends agreement, but how do you get rid of the excessive overhead and costs we have with insurance systems? There's a lot of real estate costs. There's a lot of salespeople involved that really don't add a lot of value. What's really needed? What can be automated? That's kind of what the peer-to-peer model is looking into.
As an insurance licensed advisor, I will say some agents do provide great value. So basically, let's unpack that a bit. So yes, let's face it. Insurance in general is something that has to be sold. And when I think people are often shocked and amazed by the size of the insurance industry in general, when you think about how many people are employed by it, how many people are specifically on the distribution side, like is the actual underwriting and then eventual, call it reinsurance space. The reinsurance space isn't that big really, but my God, is the distribution onerous? And I can see there being a tremendous amount of overhead, like you mentioned, that in the theoretical context. How does peer-to-peer solve for that? Is it just solely through digital distribution and lack of need for sales agents? And how would this product be discovered and basically applied or basically opted into by both sides of the transaction?
Yeah, and in my ideal visualization of this that probably won't manifest itself for decades to come or anything remotely close to it is that I would like to see it go to more of a setting where you get matched with people who have similar risk profiles as yourself. And this can be done through you filling out a questionnaire, a survey, but let's say you're buying automobile insurance, based on your prior history, we can match you with people who are sort of comparable risk to you. And then if there's slight variations in risk, there are technical techniques that we've been working on to try to understand, based on your risk profile, how much should you be contributing in the sense of it could be premiums to a single pool, or it could be another idea of peer-to-peer insurance is suppose one member of a group gets in an incident, files a claim. Well, there's no upfront payment, but you agree on the amount that's going to be compensated for every other member of the pool to that person. So transactions only occur at the claims level. And like you mentioned, there's a lot of additional operational complexities to this. You need somebody to come in and evaluate is the claim legitimate? Is there fraud in there? There's a certain amount of third party verification that's needed. And the question is what's the minimal amount of that we need to keep the fraud controllable in order to make the whole system work? And I think that's an open question and something that looking forward to working on more.
Absolutely. I mean, I think I've seen one form of this. I'm not sure if you're familiar with, and this is in no way endorsement of the company, but have you seen any of this company called Tontine Trust?
I haven't heard of them. I'm sorry.
Yeah. No. I mean, I think they're out of Gibraltar because they're blockchain based, but it is basically a digital tontine, which is, for those of you who are not students of Molesky like me, basically is a type of annuity arrangement whereby everybody puts money into the pot and the proceeds are distributed, their gains are distributed, and a kind of assumed lifetime distribution of the principal is distributed to only people who survive the period, right? So essentially, again, it's crowdsourced, for lack of a better term, it's crowdsourced annuities. Right? Just like you buy an annuity from a typical agent, it pays you for life. If you die early, you lose the bet. If someone else wins the bet, but this one kind of crowdsources it through a blockchain technology. So I think there's an application there to what you're talking about. But when I start thinking about the extension of that to, like you said, home and auto insurance, that's interesting. That's a lot of variables there. And again, essentially, I think you're essentially creating almost digital online cooperatives of people willing to share this risk. Is that a fair assessment?
Absolutely. I think it's a good way to characterize it. And I like these points you made of let's make the claims history publicly available on a blockchain, or at least publicly available within the group. But generally speaking, the more transparency you add to any system, the better it is overall, the lower the costs go down. So there's a lot of ideas that can be integrated in.
Excellent. So that's the first trend. Let's talk about the second one, which you mentioned, which is basically kind of the evolution of the digital investment side. And of course, we had the big waves of the robo-advisors coming in, threatening to destroy the traditional models. And I actually say they ended up doing us a big favor because they showed us how broken our onboarding systems were and some of our customer experience was. And now everybody's either fixed that problem or continues to fix it. So everybody, they raised the stakes for the entire industry, which is great. But what are you seeing as kind of, we'll call it the next generation of digital investment advice, that is?
Yeah, and what I'm seeing and what I hope to see more of in the future is I think of like Wealthfront, Betterment are probably the prototypes for sort of new startup robo-advisors. And they both had really good ideas. Let's look over all ETFs. Let's find the ones that are lowest price, lowest tracking error, the highest quality securities. Let's form a portfolio of these based on Markowitz portfolio theory generalizations, like traditional asset management ideas. And let's automate tax loss harvesting. They both more or less did the same thing, but let's do that at a fifth to a tenth of the fee of a traditional financial advisor. And there's a really good argument to make for that, but it's very much hands off. You just kind of fill out a survey and then it's done, right? You have very little ways to actually go in and adjust according to what your beliefs might be. And what I think is sort of Gen 2 of these is, let's extend from by analogy and asset management, let's extend from Markowitz portfolio theory to the Black Litterman model, where I can put in my information on what I think certain securities are going to do in terms of expected risk and return over the next year. Let me customize it a bit. Let me choose what strategies I want to put. Let me maybe even add my own strategy to what you're providing. I provide tax loss harvesting infrastructure, but I'm going to put the portfolios in there. There's a lot of ideas along these lines that can be used to build the next version.
So essentially moving from the template version of a portfolio to greater degrees of customization based on personalization.
Absolutely.
Yeah, interesting. Yeah, I've spoken to a couple of startups in that space. In particular, one of them, more of an advisor tool, Vias, was a previous guest on the podcast. And of course, Patrick O'Shaughnessy through O'Shaughnessy Wealth has been marketing Canvas, which is direct indexing and with greater degrees of customization. I think that's absolutely right. I think especially when you look at the ever evolving consumer and how they're treated by other industries in that everything's about customization and personalization to whatever it is the heck you want, and no right or wrong. And it's not a surprise that investment is extending into that arena altogether.
Absolutely. Couldn't agree with you more. And I would like to see the individual investor being able to be basically like what institutional hedge fund investor is 5 years ago to the day, where there's certain limitations put on you, but now you're going to have hundreds of thousands of different opportunities to get into eventually. And it's going to be a better space for everyone.
Yeah. I mean, it's just in a lot of it, I spent a lot of time defending ESG investing, not from you can debate the fees altogether. You can debate the costs or benefits of it altogether. But, if it's personal preference, just respect the personal preference. My goodness, right? If someone doesn't want to own, Walmart because they had a terrible experience working there as a teenager, then they shouldn't have to own Walmart if they want to own the entire S&P 500. Should be able to carve things off, whatever the reason, whatever their fancy, as long as they're willing to accept it, it's informed consent. So that's the second trend. Take me through the third one, and I have to refresh my memory. Third trend was?
Indeed, I think it's just sort of the growing of retail investor trading strategy development and being able to have platforms market these to the broader public.
Yeah. So essentially, I mean, we doing this well after the entire GameStop fiasco and, the Wall Street Bets fiasco. I mean, that's like a very crude version of it, right? Because we're talking about just simply, hey, pile onto this stock because of XYZ and do the short squeeze. But you're talking about something far more sophisticated, right? You're talking about the sharing of quantitative algorithms and whatnot for trading. Is that not the case?
Absolutely. I think the prototype for this right now is a platform called Quant Connect, where you can basically, they provide data infrastructure, they provide backtesting infrastructure, and you basically just code up your algorithm in Python, and they'll give you performance measures. And for your example, GameStop, if I just sort of cherry pick results on GameStop when it went booming, and I claim I have a Sharp 10 strategy that's going great, and I advertise that, hopefully people can sort of look into this, get a little feel for it before you just throw capital behind it because of analytics like what they would provide.
Interesting. Again, just raising the stakes for what it takes to actually try to squeeze alpha out of the market. My goodness. So those are the big three. So I mean, I think all of them fascinating. I think many of them resonate with the listeners. Let's talk about the other challenge you face, which is in education and getting people ready to basically be ready to work at firms like this. So how has the education of people in finance changed in light of the proliferation of fintech?
We've definitely been going more towards, or in our curriculum, more to the computer science side, getting students in the business schools to start coding. Before it would just be you go to business school, you learn Excel, and then you're basically done. But now that's insufficient for a lot of entry-level jobs. You have to have a scripting language. I focus a lot on Python, some other faculty focus on R, for example, but by the time you finish school, you should be able to code. And there's a lot of curriculum change. It used to be you would look through PowerPoint presentations, you would take a multiple choice test, you would do this 20 times, and you get a degree. That's insufficient for preparation now for a lot of the students. They need to be able to go onto the job, be able to learn on their own, acquire new tech skills that are constantly changing. And so we try to integrate this into curriculum, make them learn how to learn during the course of their education, and get them that first job is what I view my primary goal is as a faculty member.
Excellent. Yeah, it's technology and software are eating the world, and they're slowly starting to eat the world of financial education. I'll say that much. Here's a question for you. Now, you spend a lot of time in Python. How much, or have you seen at all, the proliferation or use of any of the newer no-code platforms that are out there?
I've seen a bit of it in the industry, especially on the front end, web side. A lot of no-code platforms, I think, are quite appropriate for that, where you can get a lot done with very little work. And the issue is the platforms are almost always somewhat rigid. You can operate within their framework, but you can't really customize to your heart's delight. Whereas a programming language you can, but it involves a lot more know-how and a lot more skills building up. And I think to your point of Python, I think Python's right in the middle of that, where it's a relatively easy language to learn. I see students time and time again really go from nothing to proficient in a month or 2 months. And it's quite stunning to see that.
That's and because they're students and they have the time to learn. Okay. For those of us, good luck finding that time. We have 2 kids, but okay. Continue. Sorry.
Exactly. And the students and these are the ones they're basically, they're doing it 40 hours a week for 2 months and nothing but that. And then you get to the point where you can go from ideas to code to product really rapidly. And I think that's a better place to be in than just learning, say, a dozen different tools that are sometimes good in their own right. But getting that software skill is really, where the bang for the buck is in the job market right now.
Yeah, no doubt. I mean, I think the other thing that people don't take into consideration is that I've done a tiny little bit of programming, and it's a lot of it, I got to say, just it's about learning to problem solve, isn't it? It's different than traditional financial education because you have to worry about creating structures and logic and repetitive structure. Like it's a completely different skill set and muscle to kind of flex. So if anything, I think they're just making themselves more complete learners altogether.
I agree with you there. Yeah. How do you take a big problem, break it up into modules, solve each of the modules, and then patch it all together like a puzzle? That's more or less what programming is. And at the end of the day, if you can do it well, you can automate basically all the tedious aspects of your job and life away, and then focus on the ones that really require human beings and thought and intellectual thought. And it's a good thing to learn for everybody. I agree.
Absolutely. I feel like I just missed it, being a little bit too old for it. But what are you going to do?
Never too late. Never too late.
Never too late to learn. Just need the time. That's the problem. But I'll stick to my no-code platforms for now, and I'll just wait for them to get better for now, that is. So before we wrap up, and this has been great, because I think we covered a fair amount of ground and how fintech is having such an impact. I have 3 questions I ask everybody. So I want to throw them at you and see what comes back. So the first question is, if you had one wish for something you can change in your role, and you have various roles because you consult and do various other things, in your role or in the industry as a whole, what would it be?
One thing in the industry, probably the simpler regulation overall. I think of like Dodd-Frank when it comes out, great idea in spirit, but it's written by a couple hundred lawyers. There's 500 rules. Nobody really has any idea what's going on. I think good regulation should be like math axioms. Like, here are 4 things that are simple, everybody understands, implement that, and then the repercussions are a more robust system. I would love to see something along those lines.
Yeah, so that's the difference between a principles-based and rules-based system. And you guys seem to really like your rules because it's easier to get around them. And but yeah, I mean, Dodd-Frank, yeah, great in concept for protection, but I think we've seen the net impact in terms of the decreasing number of publicly traded companies out there in the market and the expansion of private investments that have existed. And you can draw a line on that trend line going right back to the implementation of Dodd-Frank. So it might be time to revisit that and rethink it, especially given modern technology and modern systems for verification and security around publicly traded companies. But that's my rant. Second question for you, and this one's a little bit different. Normally, we're talking about the biggest challenge that people experience within their own companies to get where they are. What do you think the biggest, in your case, I'm going to give it differently, what do you think the biggest challenge facing fintechs and students looking to get fintech jobs is going to be in the coming years?
I think like the biggest challenge in terms of like getting a job for a student is really being able to like convince your hiring manager that you're able to take a deeper dive into ideas, and you're able to be like you're able to take on projects and have ownership around them. For example, with Python, the question you mentioned before, like there's a lot of people that can go download scikit-learn package, do model.fit, model.predict, and then claim they're an expert in that particular model. But then when you start as a hiring manager, like quizzing them about like what is an SVM, what are some of the ideas behind SVM, why is it better than other classification algorithms, and they can't answer anything, like that's a problem. So I find with the students, like you really need to take a deeper dive. You need to be able to build things from scratch, at least understand all the components of what you're doing, and that's where ultimately mastery comes from.
Yeah, I mean, I always love people's concept of proficiency. One of my favorite questions to ask in interviews, well, actually favorites, what the litmus test questions I ask is, everybody will put down that they're, proficient in Microsoft Office. And the first question I'll ask is, okay, give me an example of the most complex macro you've ever built. And I get a blank stare. Okay, give me an example of the most complex, the complex formula you've ever put in Excel. And they're just like, so there's a difference between being able to open it up and do the basics and actually being proficient and understanding why it is you're doing things. And I think that's just a general challenge in education altogether is getting people to understand the why, not just go through the motions of it. And I say this as someone who's spent some time teaching. So last question I have for you is, of all the stuff you see and all the stuff you've been involved with, like what excites you the most about what it is you're doing and basically gets you up in the morning to keep on fighting the good fight?
What excites me is definitely fulfillment I take in student success. I've had 3 or 4 students over the last 2 or 3 years go from basically like nothing, not the greatest high school student, but was okay, motivated, to like one is in an Oxford PhD program, one's going to Brown, one's going to CMU and Berkeley, and it's just being able to sort of take people who have some ambition, who haven't been guided in the right path, and then to show them the way, and then to see, and ultimately we're guides as the teachers, right? But you got to do it on your own and then watch them just sort of go work really hard at it and then realize that goal. For me, that's the most fulfilling feeling in the world. I wouldn't trade any high comp finance position for that. And it's I hope to keep doing that in the future.
Yeah, no, I don't fault you for the very small taste of that I've had from my part-time teaching. I totally get how fulfilling that is. You catch up with them years later and you've accomplished all that and you're thankful for what I did with you. Oh my God. Great. But yeah, that's the good side. That's definitely the good side of teaching. All right. Well, I will say this much. Dr. Taylor, thank you so much for taking the time today. Sincerely appreciate it. And where can people find you and your works? And I know, again, like all professors, you publish thoughts and papers on stuff. Where can they find that?
Sure. I put most of my LinkedIn. If you just Google Stephen Taylor, NGIT LinkedIn, that's fine. At SSRN, there's our preprint server. I have all my papers there. And feel free to reach out anytime. It's smt@ngit.edu. Happy to talk, especially about finance, fintech related things.
Yeah, I love your email. Just a lot of letters don't spell anything. Anyway, so thank you very much. Appreciate it. So that was Dr. Stephen Taylor of the New Jersey Institute for Technology. And I hope you enjoyed that conversation and then got to see basically a couple of the more emerging trends that are happening. And I'm very curious to see how group source insurance is actually going to work in the future. And if you know people who are students, I've said this before to everyone who would ask me for advice on what their kids should be taking, learn to code. I cannot be adamant enough about that. As always, if you enjoyed this podcast, please leave a review on Apple Podcasts, Stitcher, wherever you get your podcasts. Until next time, take care.
This podcast was brought to you by Woodgate Financial, an award-winning financial planning firm catering to high net worth individuals and their families. To learn more, go to woodgate.com. You can subscribe to this podcast on iTunes, Stitcher, and Google Play, or find more episodes at jasonpereira.ca.